Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'm going to sprinkle in some of my opinions as we go. It's going to be financial related, commodity topics, and or wealth building topics. Right now, I think commodities are the spot to be. Home builders, commodities, precious metals, those are the areas that I think are undervalued and have a lot of upside potential. I know some of those areas are debatable. I get it. But given what I've looked at history, given where I think the data is pointing to, those are the spots to be, in my opinion. So it's going to be related to those topics. We're going to dive in here, and I'm going to give you my financial opinion. So here we go. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com, we do have a discount. The discount's going to be this week. Look in the description link if you'd like to join or upgrade to an annual membership. So we've got bar charts. Oil futures net long positions have fallen to the bottom of their historical band. Is this bullish? Question mark. Yes, it is very bullish. We want all of the people to be on one side. We want it to be a negative sentiment. I know that scares some people, but the more negative sentiment, the more fear there is in a sector, the better it is to buy and find opportunities. It means people are selling. That's what creates negative fear. Not negative fear, negative sentiment. And that fear or that negative sentiment shows through pricing. And as long as you're doing basically opposite of everyone else, I think we'll do all right. Now, there is something I want to show on this chart that I want to point out. You can kind of see the general sentiment from 2012 to about 2018 was a general upward sentiment. Then you can see from 2018-ish all the way down, we've had a negative sentiment towards oil futures positions. I have a feeling that this downward sentiment is going to change into an upward sentiment as inflation comes back after this slowdown period. Obviously, I understand that credit growth has been pretty weak through the real estate market in the short term, but I think that will turn around. I think there's going to be a lot of home building and a lot of loaning over the next decade. And I continue to hold that mindset. China starts building oil inventories again. Wait a minute. We've got negative sentiment very low here across the board. This is only a few times in history, guys, that we were this low. It's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. About 10 times over the last little over 10 years, we've been this negative. And look what China's doing. What a smart group of people. Chinese refiners switching from drawing to building oil inventories again in October at a rate at over 500,000 barrels daily. So they're using the negative sentiment to build their inventory. Very smart thing to do at this time. U.S. leading indicators tumble for the 19th straight month. Worst streak since Lehman. Now here's another thing that I kind of look at. I didn't want to go in there. We'll just look at the chart. So you got all these negative sentiments, right? Look at the recessions. The recessions are red where the negative sentiment basically peaks, right? I have a feeling that we're probably close to a peak very soon. If not, we've already peaked to the downside. We could be coming up already. That's why we're seeing strength in iron ore, strength in copper recently. We've seen some weakness in oil. We've seen the negative sentiment, but maybe that's running close to being coming back up. So maybe the worst is behind us. I know the markets are forward looking. Obviously, I don't know with any sort of degree of certainty that that's the case, but I am seeing a lot of positive signs in the charts. And that's really where money starts to rotate. It's forward looking. It doesn't look at bad indicators and say, oh, it's bad. Well, no, the market sells off when it's getting worse, and then it usually bottoms when the worst is past us. So when we see these big red negative indicators, it doesn't necessarily mean that that's a bad time to buy. Generally, it means that's the best time to buy. Great time to buy, great time to buy, great time to buy, great time to buy, great time to buy in 2020. You know that was a good time to buy if you were a member of the YouTube channel here because I shared a bunch of my picks that went up a bunch, 10x, 20x, and greater. And here we are again at a negative sentiment or negative leading indicators, and this could be coming back up. Some people will say, well, what if it doesn't come back up? What if it dives down even further? Well, then what I'll say is don't be scared. It's another buying opportunity. Hedge yourself with time. Make your timeline longer and ride through the dip. That's the way that I view. Coming on down, we've got uranium. I said, but CAMECO's going up really fast, Dad. So CAMECO's ripping it to the upside. I do want to read a couple of these things. It says, with all due respect, doesn't this chart look overbought? My 2 cents, nothing goes up in a straight line, and CCJ might have a pause to make a nice cup and handle. Handle should form at the top half of the cup pattern. Appreciate your reply. And maybe he's talking about this potential big old, lead-in pattern here, the big cup, and then maybe we get a little handle that gets created on the right-hand side. And here we are moving on up. And what he's talking about is a lot of people look at these indicators. It could be a relative strength indicator. It could be chalk and money flows. It could be any of these indicators that are looking overbought. Here's relative strength indicator up here. Keep in mind, we can ride the upper relative strength indicator for a good long while in some of these bull markets. I am not in the camp that something has to happen, that if we get overbought, that it has to go lower, that if something remains high, that it must go down or must create a chart pattern. What I'm going to tell you is I don't know what the path will necessarily be. All I know is that when we've got the market conditions set up the way they are, we could see a monster move to the upside, and we might ride the overbought RSI relative strength indicator for a long time. It doesn't have to come back down, and we can go way over strength. So this is CAMECO. I was just showing you guys, some of the charts here. Look at CAMECO rip here. What I have is the blue fractal overlaid on it. And again, guys, I don't know if this blue fractal will be 100% correct. I don't know if CAMECO is going to go up that high. But I can tell you this. We are really early in the inflation move. We're really early in the increasing interest rate move, I think. And we have a lot of loaning to do to catch up the housing market. CAMECO went up dramatically during that same market condition in the mid-2000s. And we've got the same conditions today. Could something like this occur where we go ballistic to the upside and go up to like $400 or something? Yes, I truly believe that. And this move could easily look something like this. Obviously, we'll learn more about CAMECO and its move as it develops and continues its move. Now, is it just going to go straight up? I don't know, guys. I don't think anyone knows the exact path that this is going to take. But to me, as we break out of these resistance areas, which are coming across here, there's less and less resistance as we get above these areas. You can see that we just basically broke this resistance area here recently. Now, obviously, we could come back and retest. I know all those things. We've been sitting here doing technical analysis on a daily basis. But I'm also not going to discount that this thing could have a monster move in a monster way where we get radically overbought on the relative strength indicator. So I'm going to let this thing I'm going to let the market make me money when it's going to allow me to make me money. And I'm going to stay in there until the market conditions change. Have we overproduced uranium? No, not by a mile. Our inventory's low. Yes. When is a good time to potentially look at exiting a position? Well, I would look at inventories. I would look at the credit expansion in the system. Generally, what occurs is one of those things occur. Generally, we build inventory to a level that has satisfied the demand, and then the price goes back down. Or the credit in the system that's expanding faster than the commodities, that is what basically ends it all, and we get a big deleveraging event in the real estate market. We are so far away from that at this moment, in my opinion. We haven't built the homes. We're not in a hyper supply phase. There could be a slowdown in the market. I understand that, and maybe it does impact all of these investments. But I'm going to keep riding. I'm going to keep riding it. That's how you make money. You can't sell out when it's moving at full warp speed. You got it. Usually, you come into an area where there's consolidation, much like this area here, where it consolidated. So it was going up like warp speed, pretty fast here, and then it consolidated for a while. We had one last blow off top, and then we consolidated again. So what I'm looking for next is inventory to go up, which I don't think is going to occur. We're going to go way up in this price, and then we'll probably consolidate at some point. And that's where I'll be looking to potentially exit if there's going to be an exit. It's going to be a big consolidation. So there's CAMECO. So coming on back, weaker dollar leading to some moves in the market. And the weaker dollar, again, anything priced in the dollar, commodities are priced in dollars, precious metals, they could all go up at the same time. And what also gets impacted is a lot of these emerging markets. I've got here EWZ and EEM. There's EWZ hitting it up to the upside. And then we also have emerging markets index fund moving on up. So a lot of these emerging market funds, a lot of these international funds that are priced outside of dollars in different currencies are going to go to the upside when the dollar or the DXY falls. We've got another one here. I said, yeah, Homebuilders look really bearish. Look at this, making new all-time highs. That's Pulte Group. We've got Leonard Corp also making new highs up there. And then we've got Toll Brothers ripping it to the upside. This is what provides me the confidence that we're going to get a big housing market boom. We are breaking structures that are decades in making. This is 2008 and broke out in 2020. That's over a decade in consolidation. Generally, when you consolidate for a decade, you're going to get a big, big move. All of these big leaders in the home building in areas are breaking to the upside. And it's up to you if you want to take positions in them. You can use these as free picks if you like, but there's other ways to play it with more leverage. And that's generally why I am so enticed to the commodities group, because there's a lot of leverage to the price move to the upside with the potential credit expansion that occurs over in the housing market. That's when you get those big commodity bull markets. Copper looking strong here. So I put a bunch of things. Look at that. We're moving on up. This is a big bullish engulfing. We're moving on up. Another one that's breaking. I just zoomed in on it. Breaking out today. And then a big picture view. You can see a big bullish engulfing on the monthly candlesticks. So copper is actually firming up here. Now, the question that I would have for the recession camp is, if we're breaking on copper to the upside, and we've got iron ore also breaking up, those are industrial metals. Why are they breaking to the upside right now? What's all the fear in the market and all this recessionary talk if copper's ripping to the upside and if iron ore and all these other ones are moving up higher? And dry bulk shipping, we're seeing a lot of bottoming patterns in a lot of other commodities. I'm not saying that we can't get a slowdown. I'm just saying it is weird that all these are breaking these patterns. I buy and I look at the patterns, I buy the pattern. I don't chase price. So if the setup's there, I'm going to take it. And if we get a recession or a pullback, so be it. I'm going to ride through it. But that's my take there. Joseph Brown says, wow, Javier Malai, however you pronounce it, actually won. He's a anarcho-capitalist, basically. If you're wondering who the controversial new president of Argentina is and why the West hates him, see below. But I guess this guy, he won. There were some companies that just went ballistic today. Kind of interesting there. Building permits are one of the better indicators for future growth. Up 22% since last November isn't screaming a recession. So housing construction that we talk about, single-family housing starts, these are the permits below. and these are the starts above. They are up 21% from November 22 to October 23. Everyone's screaming recession, 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 recession. They're looking at lagging indicators and screaming that we are going into a recession. Your leading indicator is actually housing starts and the credit expansion that occurs from those housing starts. We can also look at the construction spending, which is absolutely ballooning to the upside, which also does not scream a recession. But there could be sectors in the markets that need to get flushed. At the same time, we could be getting a credit or a stimulative measure from fiscal spending, deficit spending is what's going on, and or from the real estate market. And the real estate market is firming up a little bit here, which is good. And look at the building permits. They continue to move up. So again, that's where credit and inflation originates from in a fractional reserve banking system. And that is where I'm going to remain long in commodities. Could this roll over? It very well could, and we'll continue to watch it. Patrick Karam says, silver junior miners very close to a break above step number 1. Will this be the run that leads to a break above step number 2? So the silver junior miners, 9 years in the making. We've got a lot of volume ahead of us. That's going to be a big, it's going to take some work, put it that way. But I do think that if we can get above step 1, I think step 2 is a possibility. We break step 2, we are going to the moon. That is where a lot of these patterns, they're still incredibly low, the ratios and these patterns, but with where the physical price of silver, the futures market, it's big cup and handle, massive cup and handle. If that breaks, we're going to break step 2 here, and the silver junior miners are going to the moon. I swear, guys, the sentiment in gold and silver mining companies is so bad that it draws me to it. It's like a magnet. It's a magnet where I just keep coming back. I'm like, all right, what am I missing here? What's going on? How are these things this cheap? At some point, these companies are going to make me very wealthy. And oil has already done it, but I think this group is going to do it for me too at some point. And I'm going to be accumulating in some of the companies, not just silver juniors, there's ones all across the board in precious metals. Christoph Barad says, Chinese birth at risk of falling below 9 million in accelerating crisis. Someone asked me, how can you project where mortgage rates would go and or where inflation will go? This is what projects it right here. It's the annual births in millions. And what we want to see, if you're inflation, you're going to get big inflation from this step change in births here from 60s, or mid 60s, early 60s. We jumped up in birth rates. Inflationary, and then it comes back down, disinflationary, inflationary, disinflationary, inflationary, and then you're going to get a big, huge drop off. Those big waves of the demographic contracting and growing is what causes the inflation in a system due to the loans that are created in the system. The fractional reserve banking system creates loans when these guys go through home buying years. So what you do is you add the date. So if you want to know what homes are going to do, they're going to crash in this portion here. They're also going to crash in 2020, which is coming here. This is going to be a big crash in the real estate market for China. Starting in this general area, add the average first-time home buying age. Add that here, and then after that, it's going to be a rough ride all the way down. That's going to be a disinflationary or even a contraction in the money supply, just like Japan. So you can foreshadow roughly the dates that this will occur based off of the demographics. Round down, big moves at the start of the week. We've got Western Canadian Select up 6%. It is quite low. It is quite low. We've got Uranium has convincingly broken the previous high from November 2021. The Stoke RSI is also curling up, and together with an increase in the uranium price, fireworks can be expected from the miners. Remember when we look at companies like URA, or I should say the index or ETF, we are way down here, guys. I have a feeling that if this breaks like this, right, we are going to launch for a good long time. We're going to go in a big bull market. Now, I don't know what this is going to look like. I don't know if we do something like this, something like that. I don't know if we just rip it right off the bat and then get stuck there for a little bit. There's all these different paths that could occur based off of resistance levels and stuff like that. But what I can say is we are really cheap. We've got a lot of upside potential. And I think uranium, the physical price, looks really, really strong here. Looks absolutely ridiculously strong. There it is, just ripping to the upside, right? $80.25. Someone was saying, well, maybe I should. I'm like, okay, guys, you're talking about selling when this thing is like ready to absolutely go into a whole nother gear. This is where you make all the money. The majority of the money happens when everything goes vertical. Then you got to get out at some point. But I don't think we're close. I think we're just basically breaking, this resistance line there. You've got basically, if you look, this is an inverted head and shoulders, and we just broke out of that inverted head and shoulders. If you look at this, and let's just say I throw a projection on it, let's go logarithmic, make this thing really shine here. And I throw this on top of the inverted head and shoulders. Oh, look, $250 a pound with an inverted head and shoulder on uranium futures pricing. Are you sure that's where it's going to stop? I'm not sure that's going to stop there at $250 that I just put on this inverted head and shoulders on a logarithmic chart. You guys are welcome. 250. That's one. I think we could go. If we were to do a calculation here on the futures pricing, here's my guess. I think we can go to a 1-to-5 ratio to gold. Let's say gold goes to $3,000, divide it by 5, we could go 600. 600 easy. Easy. If it overshoots and people get scared, it could go even higher. I don't know. Depends how much money's in the system, depends how much debasement the currency has. But this is a inverted head and shoulders. If I were to take this line out of here, show you guys kind of what I see. Oops, that was my line. So what I see here is basically a inverted head and shoulders pattern. Your shoulders here, your head is there, and then another shoulders there, and we've broken it. So what I sell here, oh God, no. Could we get a pullback to like this? It's possible. I'm not denying that, but there's no way I would sell at this point, guys. Coming on down, what could possibly go wrong? Cumulative global sector fund flows. Energy is low and it's coming back up. Technology is getting all the flows at this time since May of 2023. I have a feeling energy is going to be the one that rips it. That's the one that I'm betting on. Technology is going to be the one that gets hit in the head. If oil price in gold terms continues to descend, that should be treated as a clear warning of a hard landing. Oil's already at a ratio that is incredibly low. You can also see, if you look, shoulder, head, shoulder, that is developing here. If you put a line across, it's putting in a big bottoming pattern. And the oil to gold ratio is at like 26, 25, 26, something like that. That is historically very cheap. So I think we are going to go to a land much higher over the next decade. You can also draw a line through here coming across. We've broken that downtrend line. So you got a downtrend line here. You also have a downtrend line here, and that's broken. What we just did is a retest, and I think we are going to rip to the upside, breaking this inverted head and shoulders, much like uranium's doing. Oil's going to do the same thing with gold. And there's that one again. We already talked about that. Hedge funds' bearish oil bets put pressure on OPEC ahead of meeting. So we've got lots of bearish bets occurring in the oil market. Way too much natural gas production, in his opinion. You can see we've been ramping up in our natural gas production, making new all-time highs in billion cubic feet per day. Could we get a slowdown in net gas in 2024? Definitely, if the weather is a warmer winter. We are pumping natural gas at the moment. So it could be negative in the short term. It could also impact some of the energy service companies if they start drilling too much and inject too much and have too high of inventory levels. Prices will fall, rig counts will drop. and then we'll see what occurs after that. But I think it's going to be an excellent entry point because we've got a lot of liquefied natural gas terminals coming online in 2024. That's going to really move a lot of natural gas around the world. Big opportunity. Mortgage demand has collapsed, reaching levels unseen in April 1995. So we're seeing strong home builders, but we are struggling in terms of volumes of new loans. New loans in the system is inflationary, it's credit expansion, and this has drastically slowed down over the past couple of years. You can see the big move up from 2019 upward. That was very inflationary. It's an inflationary impulse move. We've come back down with the, we'll call it the unaffordability of the homes. Affordability is bad, put it that way. And it is having an impact on lending, which could have an impact on inflation or credit expansion in the system. The typical resilience of the economy during the initial phases of monetary tightening often leads investors to disregard the lagging effects of Fed policy. Here's a reminder that the Fed has been hiking rates for almost 21 months and implementing QT for 20 months now. There's a reason why the rising popularity of the soft landing narrative often precedes significant recessions. So there is a lag, and those rate hikes are going to be hitting us here with greater force as time goes on. Grady says he caught the lows in 2020 for the stock market, commodities, gold, uranium. Plus gold August 2020 top, oil low in 2023, stock market top 2021. Basically, he's done a really good job of calling tops and bottoms. And below, I called for the low of DBA back in 2020. Join us at the service there. DBA is doing a false breakout, and we have moved on up from that. So good work, Grady. Commodity to equity ratio, I usually like looking at this. You can see we've come on up, but we are still at incredibly low levels. We have a long way to go with commodity appreciation against equities or financial assets. Still incredibly cheap with a bunch of opportunities. Again, guys, this is going to be a long bull market. Be patient, ride it. I'm going to ride it. I'm going to be patient, and I'm going to ride it for the next 5 to 10 years. That's generally how long these moves occur and take. This one, it bottomed in 98, went to the peak of 2008. That was a 10-year move. This one was much faster from 72 to mid 70s. And we came down and came back up. It cycled back up. We did have a housing market bust phase here that brought it back down, and another big boom towards the end of it. The actual peak was in 1980 for a lot of different commodities. But hopefully we get a nice kind of three-wave move up like this, nice clean move like we did last bull market. This is the U.S. home construction ETF versus the SPX, the S&P 500. The thesis of home building is alive and well and resuming upwards. Nice move off that large base. This is the ITB, that international home builder, not international, it's the home construction ETF versus the S&P 500. We got a clear break above the base here, and we're going to be moving up. This is what's creating all that inflation. This is your credit driver, your fractional reserve lending. Yes, we had stimulus inflation. I get it. But this is also another big impact of money circulating in the system and reaching the hands of individuals. It's not just stuffed in financial assets. So that's what I've got, guys. That's what I've got for today. Give me a thumb up. Subscribe to the channel. Subscribe to the website if you guys like. We do have a discount turkey going on. If you're interested, you can check the description link for those discounts. All right, guys. We'll catch you later. This is Finding Value.